Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I had him on almost a year ago. He's a former analyst at Agora Financial and Stansberry Research. He trades options, and he runs the Speculators Anonymous website, where he also covers the global macro picture and other interesting investing and trading strategies. So, Adem Tumerkan, thank you for joining me again.
Great. Thanks, Jason.
Now, Adem, before we talk about maybe the bottom-up stuff with specific sectors or ETFs or companies, let's just get your views on the global macro picture right now. So around a year ago when I had you on, we were discussing the global macro picture. You're talking about a leading economic indicator out of South Korea. And the reason South Korea is important for the global macro picture is 50% of their economy is exports. So when I look at the global macro data, it looks like things over the last 6 to 8 months have just routinely gotten worse in a lot of the main export countries. Is that what you see as well?
Yeah, starting kind of May 2018, there was one of the largest drops, year-over-year drops, like the delta, the rate of change in the South Korean export growth indicator, which is one of my favorite leading macro indicators. One, like you just said, that South Korea is a very heavy export economy, and it's Asia's third largest economy, and its largest trading partner exports go to China and then America. So when you see their exports collapse suddenly, it looks like there's some demand problems, especially in the semiconductor industry. Another reason South Korean export indicator I think is very important is because South Korea publishes their data earlier than most other countries.
So South Korea has dropped like double digits in the last couple months, right? The last couple quarters, there's been a double-digit drop, more than 10% drop in exports year over year, right? So this is enormous. This is not like a couple percent or 5%. This is more than that. This is significant red flags.
Yeah, it started. So last year when I was just doing my thing, I was already skeptical anyway, just because of, you and I have discussed before about how Ludwig von Mises and the Austrian business cycle, which is a really underrated and underfollowed concept. But, it kind of goes that the tightening that central banks do plants the seeds for some kind of instability. It increases like fragility in the system. And, like all systems, there's lags, like delay effects. Like if someone starts tightening or if the Fed eases, you don't see it instantly help the economy. It trickles through, and then a year or two later, you start seeing the effects. So from the Fed's tightening, they started tightening, they began in Q4, December 2015. Yellen immediately stopped with the 2016 stagnation period. It wasn't exactly a recession, but it was like flat growth all over. And then they resumed it 2017. So by the time all that, quantitative tightening they did and rate hikes throughout late 2017, 2018, it led to the problems in 2019 that we're in today. But like you were saying, it really hits the manufacturers first, usually. And you saw the economies, like even with, I think that was interesting, was the South Korean exports and all these Singapore, Japan exports just like tanked and around May, June 2018. But what was really interesting is that they even had weaker currencies because of such a strong U.S. dollar. So, usually if you have a stronger dollar, the foreign currencies are weaker, which means gives them an export advantage. So to me, it was very interesting that you saw South Korea's and Singapore and Asia's trade collapse, exports completely collapse, even with the competitive advantage of the weaker currencies.
Well, in the long run, a weaker currency, I wouldn't call that, as an Austrian school economist, a competitive advantage. That's just what people claim. I guess in the short run, they can make things look like they're gaining an advantage. But when we're doing this interview on Friday, October 4th, 2019, which is my birthday, and the dollar index is still above 98. It's at 98.84. One thing I just learned, Adem, about South Korea is how much dollar-denominated debt so many private companies in South Korea have. So that could be really weighing as well. So not only do you have the global economy slowing down, the exports to China are getting weak, and the other countries, like you said, but you also have all that dollar-denominated debt that these I was surprised how many companies, private companies in South Korea had borrowed so much dollar-denominated debt?
Well, yeah, like you were saying, China 2018 had record defaults on U.S. dollar-denominated bonds. So they weren't able to pay their, the corporations in China weren't able to pay their dollar-denominated debts. And I think 2019 is on pace to beat 2018's record. And same thing with South Korea. The stronger dollar definitely is killing them on their real debt values, like their dollar-denominated, their bonds and all the borrowing costs and throughout the world are pretty much getting strangled right now because of a strong dollar and the higher rates from earlier this year. But now, you're kind of starting to see it ease even with the yield curve inverting. So it's kind of lowering borrowing costs on these, corporations, especially because when you have negative debt, going through the roof. But it still doesn't change the fact that a lot of these companies borrowed and the weaker currencies were supposed to help their exports. But when you have so much more companies, bogged down by U.S. denominated debt, that creates bigger fragility than any kind of stimulus of a weaker currency would have helped with their exports.
Yeah, I think that's a good way to think of things because the dollar-denominated debt is the main problem. And, what happened in the 1980s was they ended up having to do the Plaza Accord because the emerging market economies got into so much trouble that they had to beg the U.S. to devalue the dollar to help with that. So we'll see if that happens in the near future because Bob Lighthizer was one of the trade advisors back then under Ronald Reagan, and he was involved with the Plaza Accord. I think they had to devalue the dollar 50% back then in 1985. So it was an enormous devaluation. It was to prevent like an Asian tiger crisis, which later happened a little over a decade later. And a lot of the problems that emerging markets have gotten into is normally with dollar-denominated debt in the past. Yeah.
No, I agree. I mean, what's interesting that I think when you see like Trump and everybody tweeting like, oh, damn you, Jay Powell, the dollar strong cut rates and all this stuff. I mean, like everybody knows, President Trump can weaken the currency. That's like a treasury issue, not really the Fed. I mean, the Fed can do it indirectly, obviously, by cutting interest rates. But even I don't see how cutting the interest rates or anything is going to really lower the dollar because the dollar right now is like the prettiest mare in the slaughterhouse. Because, as you know, for a currency to ditch the dollar, they would have to buy something else. They'd have to sell their dollars and convert it into another currency. And I mean, you have the euro, negative, and probably might not even be around in 10 years. The yen, same thing. It's just not a great currency. The won, it's not even, you can't even, there's currency controls, all these things. No matter how big China's economy is getting, they have like no international banking with the won, no won-denominated bonds throughout the world. So, the point is that there's no like replacement for the dollar. So when you have every horse in the slaughterhouse, I guess everyone's just pegging to the prettiest one, which is the dollar.
And the other thing I get accused of is people say, like, I only see negative news, I'm too bearish, but I follow the data. And the data for the global economy that's come out this year in 2019, there is no good data for the global economy that I've seen come out. There's bad export data that seems to be getting worse out of Japan, Germany, Taiwan, and also South Korea. So if the data was good, I would report on it. I'm trying to report facts so people can make better decisions.
No, yeah, absolutely. I mean, the data, it's just, mid-2018, same thing. I probably sound like a perma-bear. I'm more skeptical than, I guess, the average Bloomberg analyst or something. But just because something looks like it's okay doesn't mean it could have like a phase transition and just suddenly tomorrow become unstable when you have things like as complex as world economies and trade. But I mean, it was obvious last year that trade was slowing down, which, when there's less trade, there's less dollar creation because the U.S. has to export those dollars. So if there's less trade in the world, there's less dollar creation. So there's less liquidity in like the dollar funding markets and like the global, liquidity. And it just starts slowing down velocity. It starts slowing down, further trade. And, it's a reflexive loop. These start amplifying. By the time last year it started, we're finally seeing the effects today. And it was really interesting. Like this year, like like you were saying, like the world's pretty much in a manufacturing recession. I think after this week's data, it's pretty much confirmed Germany is going to be in a recession, and Switzerland are right behind it. And you have the people in June when like a little bit of U.S. data ticked up. Everyone's like, oh, look, there's no recession or no problems in the U.S. or something. But the U.S.'s economy was stronger than all these other economies. So I think when Europe and China started slowing last year, when America was, strengthening, there's just going to be like a 6 to 10 month lag behind that. So I think maybe by probably by like New Year, the U.S. is going to catch up to the rest of the world. Because like we were talking earlier, there's lag effects. It doesn't just happen overnight. So all this trade's going to weigh down on America in probably over the next quarter or two.
Well, we're seeing that in the data this week. Did you see the Chicago Purchasing Managers Index and also the ISM data? It was horrible.
It was like the lowest in 10 years. It's just like all these people were saying that like the data looked a little bit better in August, but it's, it's like you and I know in these big cycles, you have these big, cyclical waves. And sometimes in a bear market, you'll have upticks of good trade, info or good data, and then it keeps going, but the trend is downwards. Or like in a bull market, you'll have, or an up wave, you'll have good trend data, and then sometimes you'll have like a bad employment data, but then the trend continues higher throughout the next 6 months to a year. So we're having the opposite. It's just been this downtrend of data, maybe some upticks here and there, but it just keeps hitting lower lows, higher high. I forget the way how to say it, but it basically we're pretty much sliding continually down.
It's in contraction because both of them were below 50 on the ratings, and it was the worst. It was the worst ISM data in 10 years.
Yeah, and the one that was really important on there, the little sub-index, the new export orders one, which is usually has a good 3-month lead on manufacturing. That one totally plunged. So going off of that, the ISM and the PMI, over the next few months should be much worse. Time will tell. You never know.
And the conference call, the stuff from the CEOs and the executives on the publicly traded companies on the conference calls have been confirming this. There's been warnings for over a month now for the end of Q2 on the conference call. So we've been getting these warnings, and the data confirms this, and yet the talking heads on financial TV are saying, oh, it's only because of 2 weeks of this General Motors strike.
Oh, yeah, it's just, those talking heads. I think it was last year we talked about it when we did the interview. I said, I think the trade, according to the South Korean indicator and other indicators, leading indicators, 2019, late Q4, late summer was going to be a trade recession and a earnings recession. And I think this year already we've seen earnings, they're flat, now going negative year over year throughout all the sectors. I think until there hasn't been enough easing, 2 Fed cuts aren't going to do anything because they over-tightened when they were hiking last year. The quantitative tightening accounted for, from what I've read, about 0.75% worth of hikes. So they over-tightened last year. And like Wicksel's theory of natural interest rate versus market rates, when the Fed artificially puts the rates higher than the market rate, it constricts growth. But then when you have, because, every economy has a natural rate of interest. If there wasn't a Fed, the economy would have its own rate of interest somewhere. But when the Fed, so let's say it's 3%. But then if the Fed comes in and pushes market rates artificially, because they can do that, to 5%, that's too high and it's constricting.
Well, I think what the large corporations have done, Adam, is that since the 2008 financial crisis and Ben Bernanke started going crazy with the intervention and taking things down to ZIRP, the large corporations took great advantage of this. So not only did overly indebted governments, large governments, borrow more and not cut their spending and not cut their budgets, but the large corporations did an enormous amount more borrowing, and then they did a bunch of share buybacks with debt to juice earnings, because if you look for revenue growth in a lot of these large corporations, there is none. Either revenues are flat or revenues are contracting pretty violently, but earnings per share over that time span in 10 years has gone up. But I think it's reaching that limit. You talked about an earnings recession. There's a limit to how much debt you can put on the balance sheet to juice earnings without any real growth in margins or free cash flow or anything like that.
Yeah, no, I agree. And that's like that kind of phase transition I was talking about. Like all of a sudden, the entire perception, like the crowd's bias will catch on. And I think like that bullish bias that was all throughout 2018 with equity investors, bond investors have already priced this in. Like last year, I was writing halfway through summer that the yield curve is going to invert because, as we talked about before, the bond investors, known as like the smart investors or the lead investors, they were, the yield curve was flattening last year, inverting because, bond investors saw what was coming. They were like, yeah, I think there's going to be higher chance of deflation and recession next year rather than what the Fed is telling me while they're hiking the short end of the curve, saying, no, there's going to be growth and inflation. So, hence, bond investors didn't buy that story. They went and they started buying the 10-year because it was trading at 3%. In their minds, as a bond investor, or at least how I would think, hey, if I lock in 3% for 10 years, this 3% will be considered high yield next year, like when rates are at 1.5% on the 10-year, which like we're at today. So all those people buying bonds last year, those bond investors, they were very, very smart and very correct.
The other thing about the global economy that I think is important here, so I think we touched on a lot of the main points about the global economy because, I would love to be bullish and optimistic, but in terms of all the data that I look at, I just don't see anything that's bullish or optimistic. I see a lot of bearish signals, whether it's the crazy stuff that the central banks are, all these central banks are doing now, or all the export data. But the other major thing with the global economy is, whether you agree with me or not, that China has a real estate bubble or credit bubble, that China is slowing down. And that's evident in their own data that a lot of their real economy is drastically slowing down.
Oh, absolutely. Like China, I've been a big critic of China, and I think they've had a credit bubble. The last three slowdowns, 2008, 2011, 12, 2015, China, I think we can agree, China has been the marginal growth engine this post-2008 cycle. So every time, like they've accounted for 49% of global GDP, if I remember right. So, if China stops being the big growth engine, it's going to bring down the whole world. Like who boosted demand when there was no demand after 2008? China. 2011, after the Euro crisis, China. 2015, they did that huge stimulus in 2015, 16, and they devalued their currency to stimulate growth, and it kind of was able to keep demand going. But now they're not doing it, and I don't blame them. Why would they now? There's a trade war. Why don't they're just doing the bare minimum, trying to keep their dollars, as many dollars as they can, just trying to keep growth enough that they don't have like civil riots or anything in China. Because as long as they keep their people happy, the communist power can stay intact.
Yeah, I would agree that they were the growth engine, but it was all back to Austrian School of Economics. It was all central planning. It was all misallocation of resources. But so many of these emerging market economies, Adam, they built their entire economy on exporting commodities or consumer products or luxury items, normally the raw commodities, especially like base metals and energy and agriculture, to China over the last more than 10 years. But it accelerated over the last 10 years because China was the main driver of demand for a lot of these commodities.
Yeah, especially Australia, like all, no, I agree. I think it's safe to say there's been, using capital cycle analysis, that there's been massive overcapacity in base metal producers and all sorts of luxury goods, everything, like cars, like huge auto bubble. All these people, it's just auto, firms, everything. They massively expanded capacity, like all this employment and everything you've been seeing over the last 5 years. Like they've overhired, they've overbuilt factories with debt, hoping that China and everything would keep growing. They'd consume this. But now China's slowing down, and you have way too much overproduction and overcapacity in these firms. And the thing is that's the worst, as you and I both know, especially after being resource investors, is that when the price falls, the best thing to do would be to scale back capacity. But each firm doesn't want to be the one to do it to lose market share. So each one, it's like the prisoner's dilemma in game theory. They'll each start ramping up double. So if revenues fall.
It's worsened. Sorry to interrupt you. That was a great analogy with prisoner's dilemma. The other problem is debt. So let's use the shale oil companies. So yes, the shale oil companies should cut back oil production. They should cut back natural gas production. They're flaring massive amounts of natural gas, which is bad for the environment. They're not storing it at all because there's no storage there for the natural gas. But what these shale companies should be doing is not producing as much oil. They should be cutting back, but they have so much debt and they hedge. So when you have that much debt, you can't cut back production because you still have to pay the debt. That's the other problem. Besides,
that's
them wanting to make a market share.
Yeah, that's a good point. Yeah, because like we were just saying, if the price of oil drops from 60 to 30 to keep revenues, they have to double output then. When you have every firm doing this, you make the glut worse. That's why, like uranium and like a lot of like commodities, when the price starts falling, you'll still see annual output supplies growing year over year, which is using capital cycle analysis, focusing on the supply side. That's usually when you want to back off until you really see that consolidation, that divestment. In my opinion, we'll talk about uranium later, but I just think there's been a lot of excess capacity and overproduction, overconsumption that was artificial because of low interest rates, like all these, consumers and everything, and debt.
Low interest rates, and assuming that China would be a permanent growth engine, that they would maintain 7-8% growth perpetually, which was just ridiculous that they could maintain this growth level.
And America hitting 4 or 5%, like I was reading on when Donald Trump got elected, they were saying they were going to the Treasury was expecting 4.5% growth for the next decade or something. Like that's, it's like absurd. Like you were saying, that's why I stay away from demand forecasts because they're so fickle. Like people they can change suddenly, and usually people are overconfident in the top of the cycle. So they, overrate what future demand will be like. And I like to focus more on the supply side, and like you said, like the supply side firms are just bogged down with debt, and they're like zombies at this point, just doing whatever they can.
They're screwed. They're screwed. They don't have good options because if they were more rational, they wouldn't have put the debt. They would be cutting back production and cutting supply and hoping the price would rise because of that. But if you look at organizations like OPEC, the history of OPEC, you would rationally think that OPEC would cut production when the oil price falls. But a lot of OPEC countries, they may say that they're cutting production, but the reality is a lot of them don't. They actually increase oil production because a lot of these oil countries that produce so much oil, most of their budgets are based on producing oil. So much of their revenues are oil. So like you said, when the oil price falls, the OPEC countries, a lot of them try to increase production to make up for the difference. So
exactly.
It's not smart market participant behavior, but it's more desperation.
No, I agree. And I don't really blame each person, because if you're a CEO and you're like, hey, listen, we need to scale back oil, because if we do this, us scaling back will, get rid of the supply glut. But they don't want to be the one that bites the bullet, because the prisoner's dilemma. How do they know their competition's going to do it? Like OPEC will say, hey, we're going to scale back, but how do they know not like Kuwait or Qatar or Iran?
Or Iran.
Not in it, but you know what I mean? Yeah, or Russia. That's why I'm not bullish on oil, and I won't be for years, because even if U.S. frackers start going bankrupt, which they're starting to look pretty ugly, what'll stop Saudi Arabia and Russia from just ramping up excess production, overnight? They have that capacity ready. I just don't trust it. I don't trust the cutbacks. I wouldn't be surprised if there's massive more tankers just hiding offshore, stored with oil, ready to dump on the market.
Yeah, I agree. Barring a miracle or the Federal Reserve allowing the oil companies to copy the banks here in the U.S. and not mark to market any of their losses on loans or anything like that, I think there's going to be in the next couple of years a very large bust in shale.
No, I agree. Going back to what you were saying actually earlier about saying how firms should be paying back debt and everything to help. Yeah, that's a great point. Are you familiar with the asset growth anomaly?
Not off the top of my head. I may know what it is, but I don't know it as that.
So basically, long story short, it's putting it simply, there's an inverse relationship between CapEx and investment returns, like profitability. So like firms with the lowest asset growth have significantly outperformed those with the highest. So like AKA firms which have gone through like asset contraction, which are like spin-off assets, share buybacks, debt repayments, divestment, outperform those that have gone through asset expansion, like mergers and acquisitions, equity issuance, increasing debt, etc., over like a 5-year period. So like you were saying, if all these firms have been doing M&As and growing their shares, so it's been killing their profitability. And we've seen that in China, like over the last 10 years. They've just grown like M&As, they've just continued investment and piling on more debt, and their profitability just kept going down and down on their firms.
I think there's a lot of bad CEO behavior right now. The commodity industry, especially oil and gas and gold and silver mining for years now, has been bad. The gold and silver miners have gotten a little bit better. They've been forced to get a little bit more lean and mean, but even though the gold price has rallied, I think, quite a lot, it's up still over 15% year-to-date in 2019 in U.S. dollars, and gold is at or near all-time highs in every other currency but the dollar. So I think, we've had a nice gold rally, but the miners themselves, even though the mining shares are up this year, if you look at the stock charts over the last 6 or 7 years, the charts are still not good on a lot of them.
Agreed. Yeah, there's been really bad, it's just skewed incentives. I don't think a lot of investors and speculators pay attention to, or policymakers pay attention to skewed incentives. Like the CEO's interest is to keep his job, to get bonuses, and to ramp up growth. Same with shareholders and investment bankers. Their job is to ride the capital cycle. They don't care if the bonds they're selling mom and dad are loaded or toxic. They just want to make their commission today. They need to make their next quarter. That's why a lot of firms that I know of from my working previously in the industry, you will see them sell tons of puts, which to me is literally picking up quarters in front of a steamroller. They'll just sell puts to pad their quarterly revenue, because they get that money up front, even though they're on the hook for the next 6 months or whatever amount of time. And it's very skewed incentives. I think it's very dangerous. Are those commodity producers who are doing that? Because that sounds like the leverage short volatility trade that Christopher Cole has been covering, where all these money managers and hedge funds and professional institutional investors, even pension fund managers, are all selling short the volatility, betting that there won't be any stock market volatility or volatility in commodities and other things. Yeah, I think UBS, I need to double check it, but there was a big Wall Street Journal thing on it. There's a class action happening against their group. I need to check which one it is. I think it was UBS, but I'll double check. But basically, investment bankers or portfolio managers said, hey, we have a new strategy. It was basically shorting volatility, and they said it had like a 1 in 100 million chance of something blowing up or whatever. And it happened, as the 2018 vol apocalypse just wiped out a lot of those shareholders, and now they're suing UBS, saying, hey, you didn't appropriately tell us the risks. You didn't say it was this bad. And it just kind of goes back to maybe they did, maybe they didn't, but it just goes back to the point of that you have these people trying to sell these crazy financial products, trying to make money today up front. Like the problem GE's in the 80s, they sold all those insurance, GE Capital is the reason GE's dying is because of their insurance, their long-term insurance contracts from the 80s. They sold not health insurance, disability insurance or whatever, nursing home insurance for people.
Long-term care, yeah.
Yeah, long-term care, yeah.
Yeah, and they severely underpriced the value of the policy, so people could get long-term care insurance that would supposedly pay for them in later years, and it was sold for a very cheap price, and people were scratching their heads back then, looking and seeing that it would eventually be a problem, but that was decades ago.
Yeah, and now they're paying for it. It's negative optionality. They, got a little small upfront reward with long potential downside, in the future, and now they're paying for that, and it's just completely killing their business model. They're bleeding out because of it. But it just kind of goes to, this whole skewed incentives. At the time, it looked great. Everybody was doing it. Everybody was making money. Other corporations jumped in, trying to cash in on it. And we just see it in every industry. No one wants to be left behind as a CEO, because they'll just go find somebody else to do it. So even if they don't agree with it, they still do these, idiotic ideas that you and me are talking about, saying that, they shouldn't be doing it. But, when their job's on the line and their bonuses are on the line, they end up just falling for the same prisoner dilemmas.
Well, it's all short-sighted behavior, though. So
yeah.
The incentive structure in corporations is really skewed to only short-term, whether that's beating revenues or beating earnings or other ways to get stock options and bonuses in the short term. So I think, corporate governance needs to change in this country. With a corporate CEO, they should be paid on successful research and development for new products. And that's how you build a long-term economic moat with high-margin products and services. And that's how you create a durable, sustainable, competitive advantage, is with new products and services that you can charge a high margin for. But, everyone's so short-sighted nowadays, whether it's a central banker or a corporate CEO or a politician.
No, I totally agree. Yeah, it's bad. It just comes down to like skewed incentives, short-sightedness. And the thing is that I think a lot of people, they confuse the authority bias. So just because someone's like Alan Greenspan, like he's a very brilliant economist and people trust him because they're like, oh, he has his PhDs and everything, he knows what he's doing. Or, oh, George Bush and Obama, they were presidents, they must know what they're doing. And they really, at the end of the day, they're still people. You shouldn't let your career or your job determine who you are as a person. And people make mistakes. And I think you're seeing all these investment bankers people trusted, these presidents, these Fed chairmen, everything that people look up to, hoping that they have the answers or that they can, do what's best for everybody when it's not. And I think, I hope they start changing things with these kind of incentive-based models and people start, maybe questioning, the potential downside from these mistakes.
Well, I think people are questioning capitalism itself, and capitalism's being blamed for everything that politicians and central bankers are doing. Capitalism's the punching bag. So maybe after the next crisis, we can have this conversation. No one wants to have an objective conversation about this right now. But you trade options. So you have to focus on volatility, looking at global macro, and then fundamentals of the companies or a sector as well. Do you expect volatility to start to come back? Because, the volatility, whether you're looking at the VIX or other measures of it, maybe it's just because of how leveraged the short volatility trade is in stocks and other markets. But we haven't had a lot of volatility in a lot of markets other than, like, the yields on the 10-year. On the 10-year U.S. Treasury, that's been very volatile, the yields on the 10-year. And commodity prices in oil. But there hasn't been a lot of volatility in a lot of other markets yet.
Yeah, see, that's the thing about volatility is that it always seems the calmest before the storm. That's when you really want to be worried. Like what Minsky said, low volatility will breed high volatility because when people feel, safer, calmer, they'll go be riskier. So low volatility, when the market starts getting too low on volatility, I look at the VIX. When it starts hovering around like the 11 to 10 range, I start kind of going long vol because one, it's very cheap at that point. And my downside is limited, and then usually you see it hit suddenly, like a big wave. So like 9 out of 10 times you'll have short volatility, and then all of a sudden you'll be a big spike of turbulence, like just comes out of nowhere. And that's the thing, like you could talk to all these macro experts and all these chartists and everything, but like a black swan is just lurking around the corner. Just because we've never seen a black swan, like the Hong Kong dollar, like I've been bearish on the Hong Kong dollar all this year. Started writing about it back in March, and I don't think it's likely that the Hong Kong dollar would break, but how the market was pricing it, I would have think a speculator into being long volatility would have found that attractive because they were pretty much pricing it as if it would never happen. And now you see all this chaos happening in Hong Kong, and the question is, it's not if that, it's not. Could or what would happen just because we've never seen the Hong Kong dollar peg break doesn't mean it wouldn't happen. That like just because we've never seen a black swan, like the U.S. dollar lose its reserve status. Just because there's never been a black swan in there doesn't mean there's not one lurking around that could pop up. So when it comes to volatility, I guess I just kind of take advantage of the Minsky perception is that when short vol will breed high vol and vice versa. So when you have a lot of high vol, usually it's best not to, you'll expect things to calm down because people will get scared, they'll freeze up, they'll start they'll stop trading or whatever until the volatility settles.
It seems that every time the VIX pops up, it just gets, within a couple days, it just gets whacked back down. So if the VIX pops 20%, 30%, 40%, within 2 or 3 days, it's down back to levels that it was around before it popped. So do you think that's like manipulation, and all the people that are committed to the leverage short volatility trade, they're in for a penny, in for a pound? So the more that the VIX pops, the more they try to short it then? Do you think that's what's going on? And it's like a version of market manipulation because they're already way over leveraged on that trade, so they figure, you know what, I'm just going to go even deeper into leverage on this thing and hope it doesn't blow up.
Oh, yeah. I mean, I'm sure. I mean, they'll deny it, but, the Fed manipulates interest rates. We manipulate every other kind of, they'll manipulate currencies. They'll manipulate the gold market. They've been caught doing it before. So I wouldn't be surprised if they're also manipulating. Oh, they got caught manipulating LIBOR, So I have no doubt that probably they're, I wouldn't be surprised.
Well, those are the large banks, not the Fed, although they're probably, it sounds like they're backed by government entities because, I mean, how many people are actually going to prison for the market manipulation? So it's part of the business model, right, that they do a market manipulation and then maybe they pay at most, a 10% fine on all their profits?
They pay a fine with the money the Fed gives them as bailouts, like the free money they give them as reserves, they pay the fines with.
So you put out a chart, speaking of the Fed, you put out a chart this week on your Twitter, which is @RadicalAdem, and you were showing the Fed's balance sheet growth. So the Fed is telling everyone that this repo madness that's been going on since it first became public late night, Tuesday, September 16th, and then the articles came out the next day, I think September 17th, about repo madness. It's only temporary. Everything's paid back overnight. But now we see that the balance sheet is starting to grow. It's up almost $200 billion in less than 5 weeks now. So what's your views on that? Why do you think the balance sheet is growing? What do you think the Fed's buying then?
So, yeah, back in August, I wrote an article called Drained, and my speculation was it kind of is a two-pronged thing that got us into this mess. The Fed started doing quantitative tightening back in 2017. That means they were pulling dollar reserves out of the banks, right? They were just taking the money off the Fed's balance sheet. They were rolling, or when the bonds were maturing, they just let them die. So it pulled money out of reserves. So banks were having less and less reserves. Meanwhile, the U.S. government has been running large deficits that sucks dollars out of the economy. And they do that so when the Treasury issues bonds, these primary dealers use their dollar reserves to buy those bonds. And so it gives the money to the Treasury. And then the primary dealers are stuck with the bonds and they sell them. But they've been holding them also, as I'm sure we've talked to in the past, that primary dealers and big banks are like bloated with excess treasuries because those are high liquid assets. They can use those in a repo. So if they need quick cash or anything, they can use those bonds that also collect yield, especially over the last year, like those bonds that the U.S. government were issuing last year at 3%. Now are, they're paying them that over the next 10 years. So they have that asset. So the Treasury, flash forward to today or recently, and the U.S. Treasury suspended the debt ceiling. Normally they don't just straight up suspend it like that. They usually pick an amount of money and they raise it and then they keep, raising it or kicking the can down the road. But this time they just straight up suspended it for 2 years, if I remember correctly. So the Treasury's been trying to rebuild their cash balance during that while suspended. So I think they grabbed $400+ billion in Q2, and then in Q3 of 2019 this year, and then they plan for another $400 to $600 billion in Q4. So that's a large cash grab. So you already have these banks who have less reserves. If I remember right, the major banks have about half the dollar reserves as they did in 2016. And I have a chart I could send you later that shows that. And meanwhile, the U.S. government needs a significant amount of dollars. So there's been a financial dollar tightening. And you and me have talked about last year, there's been a dollar shortage already happening throughout the world starting 2018. And so now we it was just a matter of time. And at the bottom of that article, I said, I don't know if it's going to be tomorrow or something, but the system's getting more fragile. The dollar plumbing is getting backed up. And I think before the year's over, we're going to have QE restarted much soon, which is much sooner than many believe. And then a month later, repo madness happened, and we're seeing the Fed come in, easing their, nerves, basically telling them, hey, listen, we'll give you the overnights. But now they're doing term repos, which are 14-day, which are the ones you're seeing on the balance sheet, the ones that are building up, because it gives them like 2 weeks to pay those bonds back. And I'm sure it's just going to keep growing from there. Like today, they just announced New York Fed extended the repos plus terms for another month. And I'm sure they're going to keep doing it each month going forward from here, because I just think that there's a huge dollar grab by the Treasury, by investors. Investors are, holding cash. Foreigners need U.S. dollars to pay debt.
We're also setting up for the Fed in a research paper from the St. Louis Fed in March was predicting actually all this and arguing for a permanent repo facility. And then behind the paywall on Real Vision TV, Danielle DiMartino Booth called a permanent repo facility, and it's being discussed in the Fed minutes in June and July at the Fed meetings. So a permanent repo facility could happen as early as this October Fed meeting announced, and Danielle DiMartino Booth called it, quote unquote, QE on demand for a permanent repo facility.
Yeah, no, I agree. And to give people perspective, like you were saying, the Fed balance sheet's already increased about $200 billion. QE1 was only $600 billion. So, I mean, we're already seeing a lot of additional expansion. And the thing is, we're not even in a recession right now. This is considered like what the Fed is saying. We're growing fine. Like, I can only imagine how bad it's going to be then when a recession does hit. You know what I mean? That's like negative optionality. Shouldn't this have been the years where the Treasury, paid back some of their debt, or the, Fed was able to hike even higher than 2.5%? Like in the good years, they were supposed to do things so they could prepare for the next slowdown or at the next slowdown. They can't even cut rates because historically you need 3% rate cuts to get any kind of stimulus. Ben Bernanke actually just said that yesterday, that they're coming up with new unconventional things at his Brookings Institute panel, which he was on yesterday. He said that the Fed can do unconventional alternate things. He didn't say what, but that could give up to 3 percentage points of stimulus.
Bernanke's been pushing since, I'm not sure if you saw this, I did an episode on this in the last 2 or 3 months. Since 2016, Bernanke's been advocating for Japan and also the U.S. to switch to zero coupon perpetual bonds, which is no interest payments on any of the bonds the Treasury issues.
Yeah, and I'm to be honest, I'm sure that's going to happen because you already have negative debt soaring. You already have companies with like double B rating that have negative interest rates right now. So, in my opinion, these people are so scared, especially in the euro. I mean, I think it's actually only in the euro because, in my opinion, they're worried that if the euro breaks, those bonds will get repaid in whatever the German currency is. So they would rather pay a premium today. They would rather pay them interest, knowing that, hey, within 10 years, if the euro breaks or whatever happens, whatever the new currency is, these are German bonds or whatever, I'll get that currency, because they don't trust all the other European countries.
Yeah, I mean, this is all one big mess. They've papered and printed over everything with fiat currency and credit, all these major economies, all these central banks and governments. They've fooled people for the last 10 years that a lot of the problems in 2008 were solved. Meanwhile, people like me were warning that none of the problems were solved, that a lot of this stuff was just even more misallocations of capital, even more debt. So, I mean, eventually it was going to hit a wall. I think we're getting within I would be surprised if after the 2020 election, if there's not problems, if not sooner. We'll see what the Fed decides to do when they restart QE. The permanent repo facility, I think, could happen as soon as this October Fed meeting, or probably at the latest, maybe November. That's what things are looking like. So many people, Adam, former Fed employees and others, are making it like it's a foregone conclusion now that the permanent repo facility of at least $300 billion will be announced very, very soon. There's not even any like 50% probability. It's that the Fed's going to go to rate cuts and then the permanent repo facility. But, when I look at gold, it looks like gold's going to be one of the main beneficiaries of this in the long run. Yes, the gold price can go up and down in the short term. There's a lot of volatility, a lot of manipulation in the paper markets, and the mainstream financial media is running. Anytime the gold price has a correction, the mainstream financial media trumps out experts in articles saying the gold price is about to crash.
Yeah, I mean, yeah, that always happens. Like, and I get the theory. Like, the idea is all these other, like, oh no, like China, all these places, they're going to need to dump their gold instantly to raise dollars to pay their debt. And, like, you know, which is dollar disease. Like, when a recession happens, that's why like gold fell after 2008 temporarily. But the thing is, I think there was a regime change after 2008, because before 2008, when there was a recession, and you needed dollars, people could sell their gold or whatever assets to raise dollars to, you know, hold on to, hoard, or pay back debts, and deflationary. But after 2008, the Fed basically came in and was like, yo, don't do that. We can't have deflation. Don't worry, we got your back. Banks, keep buying, keep, you know, pulling demand into the future by lowering rates, all these things. So, and then gold roared over the next 2 years. I think a lot of people who think that there's going to be like gold going to drop below 1,000 and all this deflationary spiral, I don't think the Fed is going to let that happen. I think they're just going to keep printing. They're going to keep giving people money, and I think
or they'll just change the rules.
Or
they'll just change the rules, right?
Monetary system, yeah. They've done it 3 times over the last 100 years anyway. So I think
or what FDR, sorry to interrupt you, or if they get that desperate and central bankers hate gold and the academics that advise them hate gold, but if they get desperate enough, they'll just do what FDR did in 1934 and potentially revalue the dollar or other currencies against gold to stop, quote-unquote, deflation.
Their inflation. Yeah, that'll get them their inflation. And, so I don't think that gold's going to, I mean, not to mention there's so many more like currency swaps with like dollar swaps, all these other currencies. I just don't think that people have to just dump their gold in a free fall for the dollar. I mean, who knows? I don't know. Maybe they would. But I think, as we've seen, that the lower interest rates go, the more negative yielding debt there is, you're going to see the dollar rally and gold rally as people dump all these other, you know, assets and currencies and just want to hold gold and dollars. Not to mention, you have central banks buying dollars. I'm sorry, central banks are buying gold each year, like an insane, like a very heavy amount since 2008. Like there was that 10 years of gold selling that was like, you know, started with England where they sold all their gold and everything from between like 92 and 2008. They were like selling gold. Central banks were net sellers of gold. But since 2008, they've been big net buyers of gold, and it's increasing each year, mainly emerging markets. And now like European countries too are buying their gold. And so now we have a net inflows of gold at a time also with gold mine discoveries have completely shut down. The gold production year over year is pretty much flat, starting to decline for major producers. So using capital cycle analysis, I think that's a pretty good, it puts a pretty decent little floor under gold, not at like 1,500, but I think the 1,200 range was a good, in my opinion, like a, you know, I don't think it would go much below. There could be some big black swan that happens, you know, obviously, but I just don't think that. I think as the Fed goes lower on the rates during this it is an easing cycle. I mean, Jay Powell can say it's a mid-cycle adjustment. I mean, it doesn't work that way. These things, they have lag effects. These are big trends and cycles. So there's going to be a lot of easing with QE, like repo, like what you said. There's probably going to be other things. Forward guidance, who knows if that's even going to work anymore, because I don't know if people are going to believe the Fed this time, because all they come out and say one thing: hey, there's going to be growth this year and inflation. You know, they have to say that. What else could they say? Oh, economy's not looking good this year, everyone. Maybe be a little cautious. Imagine what would happen if they said something like that.
There's also been big CapEx cuts in the gold mining industry. So, I mean, the CapEx cuts means that there's going to be potentially less supply coming online in the near future. And I know that a lot of the gold miners, even the ones that are making profits now, have trouble raising significant capital to fix their balance sheets or to build a new gold mine. There's so few new gold mines that are going to be coming online. So, I mean, there's a lot of reasons why long-term, I think in U.S. dollars, the gold price will be going higher. Short-term, I mean, anything can happen, like you said. In wrapping up this interview, Adem, I want to thank you again for your time. This was a lot of great insights into here. Do you think this is a good, this is not financial advice, just your opinion, do you think this is a good time to be long a lot of stocks right now? Are there a lot of things to be long, or is this time to maybe have protection, insurance, hedges, and be more defensive and cautious?
I definitely think cautious. So at the beginning of the year, I went out and bought long-term, like 1-year puts on the Australian dollar, cyclical stocks, the Hong Kong ETF, all these things. And I was like recommending it in my letter. just telling people what I was doing with my own positions. I think a barbell portfolio today people should look into. It's an important thing where so you pretty much just focus on extremes, either the extremely safe or the extremely risky. Most modern portfolio theorists believe you should focus on the average, so like the bell curve, like try to get the 4% a year, average out the really safe with the very risky. But I think it's better for people, like imagine like a barbell. You put 90% of your capital in very safe assets.
Isn't the barbell like gold and dollars? Or gold, dollars, treasuries? So that would be a barbell strategy?
Yeah, very safe, very liquid. So like last year, November, I told people, hey, doing the barbell, I'm going long bonds, mainly like because I thought there was going to be a inverted yield curve. I was writing it. I mean, whatever. Other people were too, but I went long bonds in there. And if there was going to be inflation picking up, I would put TIPS in there, Treasury Inflation Protected Securities. So like basically inflation protected bonds. Those are the kind of things you could use in your safe side, like physical gold, all that. And then on the other side, with the rest of your money, 10%, you could be in very speculative stuff like junior gold miners or something like a Tesla. I would never buy a Tesla, but like something like that. Or me, I like to use out of the money.
I wouldn't be long Tesla.
yeah. Like I use personally, my barbell is a 75-25. So 75 safe assets. Physical gold and not physical, bonds and dollars. And the other 25% is like, I'll put it in long-term, out of the money options on, sectors I like. And last year, over the last 9 months, it's been a very good team. It's been like a very big, good thing for options because of the suppressed volatility in March and then how it's blown out recently, especially in Hong Kong. But long gold. So what I would just tell people is if, with my own money that I think using the options is very important. Just never selling options. You don't want to put yourself at potential risk to blow up later. That's how you hear all these hedge funds, long-term capital management, Victor Niederhofer, all these big, very smart people who blew up randomly from one silly mistake. It's always been because they sold options. So instead of being the one selling the options and collecting the little upfront premium, why don't you buy the option for just pay the premium and then you give yourself black swan upside. So, for instance, like gold, let's say each year you buy a 1 year call option on a major gold producer that's kind of out of the money, and you pay 10 cents a contract. So you put $1,000 in it or something. That's like a less than $100 burn rate a month. And then, let's say nothing happens. So you lose $1,000, $100 a month, not a big deal. Next year you do it. So it goes down the drain again. And then the third year, finally, that gold blows up. Something happens. You don't know what it is. Just the cycle turns, bear markets create bull markets, all that thing. Gold roars, or like what happened this year. And that $1,000 goes up 10, 20-fold. Statistically, it already makes up your $3,000 each year, putting 1,000, 3 years losses, I was saying. You already make, so let's make a 20-bagger. You make a $17,000 net profit. So like uranium right now, I like uranium just because we're finally seeing the big supply cuts. Since 2016, there's been over 20% drop in the annual output. That's deep cuts to the output. We're seeing big mines shut down. We're seeing big divestment. So for me, I would go long I wrote in my free blog part that, I was buying Cameco calls for 6 months to 1 year because worst case scenario, I lose the premium. I lose $500. Best case scenario, it goes up 10, 20, 30-fold, and you make 1 year can pay your bills for, a couple of years, you know what I'm getting at?
Yeah. So it's about trying to understand risk reward and making sure that you're getting a good amount of reward for a minimal amount of risk. And this is what the average retail investor doesn't do. A lot of hedge funds don't even do this right. Hedge funds make leverage bets. They don't really hedge a lot of it. I know very few hedge funds that actually hedge. So, the retail traders make a lot of the same mistakes. The thing that the retail traders try to do, instead of doing fundamental research and then technical analysis on charts and then maybe using options for hedging or leverage, again, not financial advice, just my opinion, the main mistake that the retail traders make instead is they look for these double 2x or 3x, triple double or triple leverage ETFs rather than using options after they already did the research or for hedging or for leverage.
Yeah. The thing is also there's a thing called prospect theory where that's what Daniel Kahneman figured out with his partner Amos Tversky, behavioral scientist. Prospect theory basically says humans hate losses 2.5 times more than the equivalent feeling of a win. So basically, you feel your losses much more. You hate being wrong and feeling your losses. People think like, so a lot of investors, and I used to be like this too, is that you confuse being right with making money. So like saying, hey, I think the trade war or I think U.S. economy is going to do better this year, so I'm going to be long this. Instead of looking at it, but if everybody thinks that, it's already priced in. So your upside is maybe 1%. But if something happens, suddenly the U.S. doesn't grow, it could drop 10, 20%. So people are too focused on being correct when you want to look at the asymmetric return, like where it gives me the best expected value, which gives me the best upside. So meaning I would rather lose 9 out of 10 times small amounts of money, but then that 1 out of 10 time make, 10x. Compared to most people who like to make small returns 9 out of 10 times, but then they end up losing 50% 1 at a time because it feels better. They want to see those small wins. And everybody's like that. They don't like seeing small losses build up. They'll get frustrated, which is fine. But to be a good investor, you have to go against the grain, like what Mark.
You have to be contrarian, yeah. The contrarian pays if you know what you're doing, yeah.
Yeah, and it takes time and everything, and it sucks. Like at the beginning of this year when I loaded up on like gold calls and I bought Hong Kong puts, I bought Australian dollar puts, and like March through May, I probably looked stupid or something because none of it worked. I was down like all my options. I mean, I was just averaging down because they were falling. I was down like 50% on them, but it didn't matter because the most I could have lost were those premiums. So it's not like I could have lost more than the $500 I put in each one, which is better because I'd rather, instead of putting in $20,000 in a stock, I'd rather put in $500 for the equivalent amount of that stock in options. I mean, that's an option core. Obviously, I don't want to get on to that, but the point of what I was getting at is then all of a sudden June happens, Fed cuts, gold soars, the data with the trade war and everything came out starting in May, and the U.S. had just started collapsing, and all of a sudden you log on to your brokerage and those puts that made you look really stupid the day before soared, overnight. You're up like 500%, 600%, 700%. And it's not like you're a genius or I'm some smart guy that did something. It's not like I could see the future. It's not like anything I did changed the outcome. It's not like I went to Hong Kong and like investigated anything. It's just all I did was look for something that had probably was the market was discounting to way off more than what my own opinion of that outcome could have been. You know what I mean? So I think if people just look at it more as, you're placing bets and you got to understand like I could be wrong more often than being right, but you want when you lose money to be little, and you want when you make money to keep your upside unlimited and ready to run. You know what I mean? You don't want to cap your upside, which is like negative asymmetries. When you cap your upside and get a small gain at a big potential down.
Wasn't it a famous trader, Jesse Livermore, who said cut your losers and let your winners run?
Yeah, exactly. So like buying a call option, to me, it lets you do that. Your upside's unlimited. Like on a call, the stock price can go as high as it wants. But if I buy something, like if I bought a gold miner, like I was saying, so like let's just use that uranium as a little example, because like I see a lot of people who are really big on uranium, but then like they buy all these uranium stocks and then they'll drop 50% and then they're stuck there. To me, that's a liquidity problem. And I imagine putting $100,000 in gold stocks or something, then they drop 50%, just bleed out slowly because your thesis needs more time, or you can't control the market. Anything can happen. But then so now you're down 50%. Your market value is 50% off. You only have 50,000. Then imagine there's like a family crisis or a medical bill, and you have to sell low. This happened to me before actually, and you have to sell low just to get whatever money you can because you have to pay a bill or something. But you're selling it at 50% loss. So to me, it's like, why put so much up front when you could just buy some like options or like calls on uranium each year? I'd rather lose $2,000 that give me, $50,000 worth of shares, but you're only paying $2,000 for the option contracts. So I'd rather lose that 2-3 years in a row lose 2,000 each year. But then all of a sudden, year 4, finally uranium blows up. Something happens. Supply, you know what I mean? Anything could happen in the world, in these markets.
And you get your 10x or 20x returns, and then they more than offset your losses.
Exactly. Yeah. Like I was just saying earlier, like that's, I think people aren't like really, they're not as patient.
The average person doesn't think about things like this. The other thing here is that you actually have a track record of success doing this. So, it's one thing in theory to say that this will work. It's another thing to say, well, I have a strategy and I stick to it, and over 1 year, 2 years, 3 years, 5 years, it actually works out. So your strategy is based off very successful hedge fund managers, right, off of Nicholas Taleb and Mark Spitznagel, right? This was a strategy that they came up with when they were managing money, and they were very well-respected hedge fund managers on Wall Street, right?
Yeah. So basically, Taleb's idea was like the Anti-Fragiles books, and he doesn't really, it's more of a philosophy book, and he doesn't really say how he did trading stuff, but you can kind of get a gist of it. So one day I was like thinking, I'm like, his big concept is do things in life where volatility is your friend. Don't let volatility hurt you. Let it work for you, because you don't know when it'll happen. And like, it could happen with anything. Like think of like the underdogs in like the Super Bowl or anything, or UFC, and like an upset happens. Like why bet on the crowd favorite when you can only make, 10%, but you're risking so much money to make 10%. But then if a fluke happens and a wrong fighter gets knocked out in the UFC, and then you lose so much. But if you bet on the underdog, you risk little and you get so much more reward. I mean, most likely you'll lose more money because these are priced out for a reason. But you want to look for bets where the prices are, mispriced, where the market discounts things. So that's why I like out of the money options, because they're very greatly discounted often because they're far out of the money and not many people look at them. So, that's just some strategy that's worked for me after this 2016. Like I was really big in gold. When you meet back like years ago, I was big in gold and I was buying gold shares. And then, same thing happened. I had a family emergency, had to sell, and it killed me because I had to sell at like a 60% loss, even though I was convinced gold was going to do well. So I ended up just taking 1/10 of that money, buying the same amount in gold mining options. And then in 2016, when gold like broke out from like 1,000, hit like 1370, I made 19x on one of them. And, I realized like, wow, like I really capped my downside here because the most I could have lost was a couple thousand. But, the gains I made were significant. And, that's just something that I've really brought into this. I use the optionality, the Taleb optionality, anti-fragility strategy with cycle theory. So you can find like when cycles happen. So like last year when the South Korean trades were falling, I was like, okay, it's probably a good time to start buying puts on, Australian dollar or long dated puts, because they might not be priced in today, but in 6 months from now, I'd rather own those insurance contracts, because options are insurance. So I'd rather own those for the future so that when something does start happening, I could just sell them, or, probably some hedge fund will want them from me at a much higher price later. So I'd rather lock in those contracts today. I think before I know you're busy, but I think of it as like you're fishing and you're throwing out cheap bait with your fishing rods. And it doesn't matter if a fish steals one of your little baits because it costs you so little. But every now and then you're going to get a really big fish, and it's going to be, significantly worth it and pay for your next 10 fishing trips. So that's kind of how I like to look at it.
And in my opinion, there's a lot of different ways for people to make money investing or trading different markets. But normally when people get in trouble, it's the trader who has losses and then holds a position longer than they should, or the long-term investor who has a lot of money on a short-term trades and then starts becoming a short-term trader when people start deviating from their strategy. So again, this is not financial advice, just my opinion, but you seem to have a system and it works for you, and everyone's risk tolerance is very different. There's people that would be very uncomfortable with your strategy, but for some people, your strategy is going to work very, very well for them.
Yeah, for sure. Like it's, people got to definitely look at themselves in the mirror and be like I know some people, like they want to be contrarian investors. They get it, but they don't have the emotional strength for it. And it's nothing wrong with that. It's just they don't want to look at the red. It hurts, them mentally, and which is prospect theory. Humans don't like that kind of things, or hyperbolic time discount. There's so many human cognitive flaws that prevent us from being like efficient traders.
Oh.
And that's why I like the barbell strategy. It lets people kind of choose what they want. They can do very conservative, 95% of the money, very safe, conservative assets, and then 5% in like money they want to like be speculative with, or be more risky, 80-20, or like me, 75-25. You can do whatever you want. So yeah, definitely. And this isn't investment advice either. Obviously, everyone needs to like kind of find what works for them and makes them sleep at night. But personally, the best advice I would say is make sure that your downside is hedged. So if something does happen overnight, you don't wake up and see like all your money gone, or like your Victor Niederhofer long-term capital management and your downside blows up the world.
Or the guy from optionsellers.com who was selling puts on natural gas, but that was like 2 years ago or something, year ago, 2 years ago.
That was last year, that was last year.
He built up a hedge fund he was managing hundreds of millions of dollars, and his only strategy was a one-trick pony. He was just selling puts on natural gas, and then natural gas had a big spike, for a couple months, and it bankrupted him. And now I think he's divorced. He's being sued.
He should,
His life's a mess.
I got actually interviewed in the Tampa Herald over that because I wrote about him, and the story's crazy, and it's just totally reckless. Like it worked for see, that's the thing. It can work 9 out of 10 times. See, you don't know. Like these things are so random. Like all these macro experts or these big financial experts to tell you like, oh, I think this is going to happen today and going to happen tomorrow, and nobody knows the future. So like I don't want to sit here.
He was making. That guy was making money, hand over fist for 7 or 8 years. He had hundreds of millions. He was worth millions of dollars personally. He was managing over a couple $100 million. So he had a successful business, but, he wasn't hedged. It was a one-trick pony. He kept increasing the size of the trade, even though that was probably stupid to keep increasing the size of the trade because he wasn't diversified at all. He was a one-trick pony. And then it blew up.
The worst is that he had a fiduciary duty to the people he was like investing their money. Like he didn't explain to them the potential downside or anything, which to me was insane. Like it's just sick. Like how you could like, if I was investing people's money like that, like, I would not, it would be very conservative. I would not be speculating, betting on black almost each time because, he really blew up. That's the term Talib calls blowing up. So in my opinion, that's very fragile. Instead of being robust or anti-fragile where you want to benefit. So those days where natural gas blows up, too bad he wasn't positioned or read the book Anti-Fragile. He could have positioned himself with calls on natural gas, and he could have offset his losses then by owning call options, but he didn't. And it's a shame. I feel bad for a lot of those people that he lost all their money.
Well, a lot of people don't hedge, even hedge funds. So he had an enormous leverage bet one direction, and then he had no protection the other way. And with your strategy, he could have had, 10% or less on hedge protection in the bets in the other way and been hedged on that trade, and he didn't do it. So hindsight's 20/20, but the majority of people I know where their trades go wrong, especially on shorting trades with puts or shorting stocks, they don't hedge at all.
Yeah, no, that's the problem. And you never know the future. There's black swans lurking everywhere. Like repo madness, what happened a month ago we were talking about. That just literally happened out of nowhere. And then after the fact, people started saying, oh, because of this and this. These things have snowball effects. Systems are nonlinear. One little thing, like the butterfly effect, a butterfly flapping its wings off of the coast of China can create a tornado in Spain 2 weeks later.
It's not the butterfly effect. Let's call it the leverage effect because, a small little move in one market, like let's say the oil price having a correction, we don't know how many hedge funds were short oil prices with leverage or the 10-year treasury, right? Last year, in October, the 10-year treasury last year was 2.7 something percent. Stanley Druckenmiller in March or April publicly talked about zero interest rate policy in his going long treasuries and selling stocks. So a lot of people copied that trade, probably with leverage. And now you have the rally in yields on the 10-year treasury. It bottomed a little bit below 1.45%. And I haven't looked at what we're at now. Let me take a quick look on the 10-year treasury.
I think we're at 1.5.
Okay, so it was higher than that. What it was at 1.8 at one point a week or so ago, right? It had rallied pretty strongly.
Oh, I thought you meant today it was at 1. Oh, yeah. Yeah, it hit
Yeah, it's a 1.5. Yeah, it's a 1.5. Yeah, I didn't look at it today, but I meant like it had rallied strongly,
Oh, yeah.
and I'm sure that people who had done that trade copied Druckenmiller with leverage, if they were betting on lower yields, they were in a lot of pain when it was the trade was going against them.
But in my opinion, they were too late. Like, why were they just buying bonds when the yields were at 1.45 when last year they could have bought it at 3%? So that's another thing. People need to understand where they are in the cycle. Like, once it's already priced in, you know, you got to be careful. That's why right now, I mean, like, I had a lot of plays in the beginning of the year, but now I'm kind of cooling off, just waiting for the market to, you know, misprice things, because I'm not about to go out there and be bearish on, you know, U.S. economy, because I don't think the U.S. economy and the world economies are going to grow. I think there is more downside ahead, but it's starting to be more priced in. When the more priced in it is, the more downside risk it gives me if I buy it now.
Yeah, I think it's a time right now to be cautious. I personally have cash. I have physical gold and silver, but it's not an investment. It's just for savings, insurance, and wealth preservation. And then I have positions in some well-researched gold stocks, not a lot of gold miners. I have one speculative position in a silver miner that's about to start silver production. But most of my shares are in a company that's actually making money that benefits if the gold price goes up, down, or sideways, and there's very few gold companies like that. You know the company. We've talked about it a lot. My comments are very public.
Yeah, no. And it's done well this year. I own calls on that, and it's really done nice over the last 6 months.
Yep, and next year it looks like they're going to be, well, actually they just put out a press release, Sandstorm Gold did, and it looks like they're going to have their first 12 months of over $100 million in annualized revenue. So that's a big accomplishment for the company. So while other regular primary gold miners are struggling, can't raise money, if the oil price rises, their margins are in question, their balance sheets are still questionable, this company, record revenues.
So definitely a good one.
Well, unless the management team does risky stuff like what Osisko Gold Royalty Management just did, because that was a royalty and streaming company. Now they just bought a gold miner, and they're going to try to build the mine themselves. So hopefully Sandstorm Gold doesn't do that. Okay, Adam, well, I've kept you long enough, over an hour. You've given my listeners a lot of great insights. I want to thank you again for your time. If my listeners want to follow your work more, take a look at your newsletter, how do they do so?
They just got to go to speculatorsAnonymous.com or follow me on Twitter, Radical Adam. That's ADE as in Eve, M.